everyone. Thank you so much for joining us today for a very special presentation, Raise Capital for Your Startup, How to Create Value Out of Nothing. I'm Vasil Azarov, Program Director at the Startup Socials. Startup Socials is a global community of entrepreneurs built to connect and empower people in the startup ecosystem. Before we get started, I would like to thank our partners today, Early Growth Financial Services and Rubicon Venture Capital. Few housekeeping reminders. Today's webinar is being recorded, and you will receive a link within 48 hours of today's broadcast. If you have any questions for our speakers today, please post them in the chat box at the bottom corner of your screen. If you would like to tweet key takeaways from today's webinar, use hashtag StartupSocials. I'm very excited to welcome today's moderator, David Ehrenberg. David is a founder and CEO of Early Growth Financial Services, an outsourced financial services firm that provides early-stage companies with day-to-day transactional accounting, CFO service, tax, and valuation services and support. He's a financial expert and startup mentor whose passion is helping businesses focus on what they do best. And with that, I'm going to pass it on to David. David, please take it away.
Vishal, thank you very much for that warm introduction. I'm honored to have been asked to moderate today's webinar, and I'm very pleased to introduce our presenter today, Andrew Romar. In addition to being the co-founder and general partner of Georgetown Angels, Andrew is also the author of the entrepreneurial Bible to Venture Capital, Inside Secrets from the Leaders in the Startup Game, which definitely earns its title. I recommend this book to startups all the time. It's a great resource and highly recommend that you pick up a copy. It's packed with invaluable advice about how to raise angel and venture capital funding, how to build value in your startup, and how to exit a company with maximum value. Andrew has a wealth of knowledge to share on raising startup capital. So let's dig in. Andrew, thanks a lot for joining this call today and for being willing to present. I think you have a lot of valuable things that you can add. Can you please start by just talking about what the concept of a startup ecosystem is and how you can begin to build your startup network?
Absolutely, and thanks guys for setting this up, and it's great to be here. So I think that just having an idea, and particularly when I see someone with an idea and they're protecting it and they're being secretive and they're asking for people to sign confidentiality agreements and that sort of thing, I think ideas without a team and without either capital financing it or revenue are somewhat worthless. So as a starting point, a way to get started is to, take whatever idea you're going after, or even it could even be as simplistic as a market, like a marketplace that you want to go after, and starting to form, pulling in co-founders, I think is a first step, and then starting to build a bit of a network around your company to support it. I would suggest people that meet you, David, if they could get you involved with their startup at an early stage, that's a great start, and then you might be able to bring someone else in your network, to support that company. So there's different ways. There's different ways of doing that, from advisors to angels to venture capitalists to strategic partners to customers that are feeding you revenue, and to lawyers. So we can jump into any of these topics, that you want to.
I think that's great. I think that's a great overview. And I'd like to just tell everyone that's listening in on the webinar that you can submit any questions that you may have for Andrew on the chat box in the lower left corner of your screen. So as we go along and have this dialogue, please feel free to contribute questions and anything you want to ask Andrew. He really is a wealth of knowledge. Andrew, in terms of if you're new to the startup game and you don't have a lot of those contacts in terms of lawyers and advisors and accountants, how do you begin the process of finding those folks?
It's a good question. And I think that in today's modern startup ecosystem, there's absolutely no excuse to cry and say that I wasn't born in a yacht club privilege with Mitt Romney as my father or anything like that. I think that you can totally break your way and network a path to almost anybody. So if you feel like you're completely on the outside of things, I think a good starting point is start going to networking events. David, you're in New York today, and you're in San Francisco most of the time. I think everywhere in the world, from Barcelona to Amsterdam to anywhere, you've got tons and tons of networking events. And if you're truly not connected to anything, you can just go to meetup.com and start searching for networking events that are in your area. Bring some business cards with you and start meeting people. Theoretically, you meet one person and you get introduced to another person. If you start asking around for introductions to lawyers that do a lot of angel and venture capital deals, and it's usually these corporate securities guys that do the financings and M&A work and IPOs and all that stuff. Those people know a ton of people. So, I would say if you're completely feeling unconnected to the ecosystem, start by going to networking events and try to meet a lot of people, and then start asking, if you're really ready to get going with a startup, start asking to meet with lawyers. When I founded my first startup in 1997, I think I took like 8 or 9 meetings with lawyers before meeting with one single angel investor. So for me, the order was lawyers, angels, VCs. I think today I would consider trying to wrap advisory people around your deal even before going to the lawyers. It depends what stage you are with your career. If you've done 10 startups already, that would be different. But if you're really on your first startup, I think that if you ask for introductions to lawyers and you've got a respectable, good, attractive startup, people are keen to make those introductions. I like making introductions to lawyers because I feel like I'm doing them a favor by sending them a prospective client. And I hope that I get some good karma points with them for doing that. So I'm always happy to introduce someone to a lawyer if I think it's a fundable, good, high-quality deal.
I think that's a great point, Andrew, and I think that that's fantastic advice. In your book, you talk about an advisory financing round. Is this concept connected to what you're talking about in terms of pulling together your initial advisors?
Yeah, so I think, if a lot of times, first of all, most startups fail, and most startups will change strategy and change course as opportunities present, or they're, finding things are not working, and often people are referring to that as a pivot. So I think that if you've got an idea, it's a good start to make sure you're not having a hallucination and that it's more of a vision. And so it's a good idea to reach out to people that understand the industry that you're disrupting or planning on getting into and seeing if they like what you're doing. So, for example, if you decided you want to create a Bitcoin startup, you want to create a business in the Bitcoin sector, then it would make sense to reach out to some people that understand Bitcoin. So I'm kind of in a New York frame of mind talking to you, David, as you're there in the WeWork. Barry Silbert comes to mind. So, Barry Silbert has been early and active in the Bitcoin space. And so that might be someone to aspire to get involved in your startup if you like the guy. You might make a list of other people, that are that have, involved in that space, or maybe even come from the payment space, people out of the PayPal mafia, things like that. So, and another way of thinking about this is just to say, who do I know that has experience with startups? Full stop. It doesn't have to do anything with the sector. And who do I know that's big in financial services? Maybe someone that works at Visa. And this is just sort of for someone that was going for Bitcoin. If you were going for the travel industry or the hospitality industry or something, a different sector, start thinking of bringing in big gun, powerful people that are going to be able to make you successful. Think of people that will be able to open doors for you and give you advice to make sure, one, your idea is not foolish, and that even for people that understand that industry and understand startups, they are ready to support you with their time, which is very finite, and perishable. And so if you can start to recruit some of these people around your company, that network around your startup is your startup, from my perspective. And just this morning, I agreed with my partner. I'm based in Silicon Valley, and Josh Siegel's based in New York. And we agreed to make a wire transfer to a startup and invest in that startup. And part of our comfort was I saw Jonathan Ebinger, who's a general partner of Blue Run Ventures, a big VC fund I've known for many years. I've got a very high respect for Jonathan. Seeing that Jonathan had made an angel investment into this company himself did a lot to make me comfortable with it. So I'm trying to give an investor's perspective of how important it is to see other people supporting the venture. It's not always the case with us, but in this case, that was a big plus sign. Then Joe Lonsdale, whom we know, he's the founder of Palantir, and this was a big data play that we're investing in. He's today the largest investor in the company and had invested about 2 weeks ago into the venture, and we've been talking to the guys at Formation 8, his venture capital group. And, so just seeing the right kind of people around a startup that are appropriate for that startup is very, very important. Also, to the theme of trying to create something out of nothing. If you focus your time on trying to get investors first, you may find that the time is ill spent and that investors are taking your meeting, which is actually bad for you. They're starting to take up your time, but you may not be getting funded. If you take an approach of trying to recruit co-founders and building up your team and then recruiting advisors to help you, you might find that the progress is a bit faster. With co-founders, I think it's very important to have at least one co-founder. I think a one-person team is frightening to an investor, and they rarely really succeed. So I think that getting a co-founder is incredibly important. As far as how to structure advisory rounds, I talk about this in my book, and at a high level, you could take an approach, and even a mental approach of saying, I'm going to dilute myself and my co-founder by 5%, and we're going to give 5% of the company to a group of advisors. But we want to make sure that each advisor...
Can I interrupt you for 1 second? You use the term dilution. Can you just explain for the audience, in case anyone doesn't know what dilution means, what you mean by that term?
Yes. So imagine David and I found a company, and we're 50-50. And so the capitalization table, or the ownership structure, like the pizza pie, is owned 50% by David and 50% by me. If we intend to bring investors in, they're going to buy some of the pizza, some of the equity, and David and I will get diluted. So we would go from owning 50% each to owning less than 50%. And so we might get diluted selling some of that stock, some of the ownership of the company, to this advisory group that invests a little bit of money at a very low valuation. Then we might go on to raise more money from angel investors at a higher valuation. So for dollar, they're getting less percentage points ownership of the company, but the valuation is going up, and we continue to get diluted. And what a lot of people don't realize that are first-time entrepreneurs is that the average venture-backed company that gets to an exit has at least 5 venture capital financing rounds. And often these days, startups are raising multiple angel rounds before getting any investment from VCs. I think I published the financing history of OpenTable in my book as an example of a company that made it to an IPO. And I think they had 9 venture capital financing rounds in that company before getting to the exit. Each time they did that, you can expect that the founders were getting diluted, and even the early investors that didn't continue to invest more money into the company in the later round.
I think that's a great point. And I did not mean to cut you off by asking you about
jump in, David, please.
No, definitely. But you were talking about pulling together that advisory round. Along with that advisory round, Andrew, you talked a bit earlier about how important it is to select a lawyer. One of the things you said was you should try and find a lawyer who can help you within the ecosystem. What are the other things you should look for when you're initially looking for a lawyer or other service providers?
Right. So for example, we were chatting before the call this morning. The number of startups you personally, David, have been involved with is significant, and I think a lot of people don't, understand that. So if you're Jack Dorsey, I don't know exactly how many companies he's been involved in, but I know he was at Blogger, Twitter, Median, and Square. That's 4 companies. So he's got a perspective of 4 different startups, and there's probably many more. But it's quite common that an entrepreneur is spending 2 to 12 or even 15 years per startup in their lifetime. And there's only so many startups that they can, only so much diversification portfolio they can have in one lifespan. If you look at a venture capitalist, they might be doing 15 to 20 companies per fund and raising a fund possibly every 3 years. So they're seeing a lot more companies. But if you talk to a lawyer, at Wilson Sonsini or DLA or Oric, Goodwin Procter, any one of these guys, they're seeing like 100 deals in 1 year. I mean, David, let me ask you, how many startups have you been involved in just in the last 12 months?
We have 450 active clients right now, but I've probably helped 250 raise funds over the last year.
Yeah,
but that's a big part of what I do.
So 250 companies in a 12-month span. So David is someone who has a very good sense of even the changing sentiments in the market week to week and month to month, as valuations for pre-revenue companies are getting higher or lower and that sort of thing. So to get someone as an advisor who has active relationships with the investors, they know which investors are out of money, they know which investors have money, they know which investors are going to pull the trigger on investing in a pre-revenue company versus a company that's even EBITDA positive, generating profits and generating cash. So this comes back to selecting advisors that have different complementary skills for what you need. So you might need someone that has industry contacts that will help you land a big whale customer and a small customer getting first revenue, someone with expertise and guidance on the industry, and someone else who just really understands the money. I think with lawyers, there's small boutique law firms and there's these big, massive law firms. I tend to think that if you're a good startup and you can get the large law firm to support you, it's worth going down that path. They're going to charge a much higher hourly rate, but they're usually willing to defer fees. They probably don't like me to say this in such a public forum because they're going to try to charge you, but if you can get them to not make you pay your bill until you've got the cash flow from a big financing round, then that'll help you spend the money on staying alive through the very early days. And that's probably better. And if you're choosing the right law firm, they would be able to make introductions to angel investors and VCs. And for most of the investors, what happens is that they get overwhelmed by receiving so many emails and inquiries for financing that the ones that they can process that go to the top of their list are the ones that come in from someone that they know, that they think of as an initial filter on the deal. So if David were to send me an investment opportunity, and I know David, and I understand his knowledge in the sector, I would immediately give a look to it. And even if I didn't like it, I might even agree to speak to the entrepreneur because of my relationship with David. So that's the most that the entrepreneur can really hope for, is to get an audience with the investor and try to communicate, their opportunity.
Thank you. Thank you very much, Andrew, for the compliment. But I agree completely in terms of picking a great lawyer, and I think that's wonderful advice. I'd like to remind everyone that if you have any questions for Andrew, you can submit those questions on the chat box in the lower left corner of the screen, And Vishal, were there a few questions that have come through that we could ask Andrew from the audience before I proceed?
Well, yeah, so I'm looking at it. Oh, I'm sorry. I can see the questions on this web chat thing.
Wonderful. Are there a few that are pertinent to where we're at?
I think so. There's a question from John Lawler. What is the best way to identify the highest prospect angel investors and or VCs for my business, and what is the best way to approach them? So things to consider are geography, sector, and stage. And then a fourth kind of more hidden thing to consider is where is the venture capital group in the life cycle of their fund? And then probably the next key thing to go after is who's the correct partner that I actually want to do business with at that fund. So, so obviously if you're a social media, web app and advertising or something, it doesn't make sense to go after a big clean tech VC fund that only invests in European clean tech companies that are later stage, right? So you want to try to get a fit with making sure that that venture group is active investing in your geography where you live and where the company is headquartered. And so good luck being in India getting funded by a company that only invests in Boston or Silicon Valley. And then you want to get sector overlap for many reasons. One, to see that it's possible to get money out of them, but also that when they invest in your company, it's likely that they're going to be a positive board member and supporter of your company rather than a toxic VC who doesn't understand what you're doing. Stage is important. There's a lot of larger funds are trying to figure out how to make seed investments, and that's been changing quickly in the last year. But if the company does not make investments, of the size and stage of your company, then you should make sure you're not wasting your time by just educating them on what you're working on. And then, the last thing is make sure that the partner that you're dealing with at that VC fund or even angel is someone that you've got good chemistry with and, you're ready to be shoulder to shoulder with for a long path that'll have, lots of ups and downs. What's the best way to approach them? One kind of trick that, I don't want to say trick, or it's like a specific practical thing you can do is if you don't have a good introduction to the venture capitalist or the angel investor, find out what other companies they have already invested in and try and approach the CEOs of those companies. So, if you see that an angel like David has made an investment into a company, and you're able to see that on Angels List, for example, or Crunchbase, those are two good resources, AngelList and Crunchbase, by the way. And you can see what companies they claim that they've invested in that have been validated. You might be able to get that CEO on the phone, and not only are you networking a path to that angel investor or that venture capitalist, but you're doing due diligence on that investor. You're finding out, is this person a world-class, jerk, and has he turned out to be a crook and a bad operator? Or are they saying wonderful things about them? So it's not a bad use of time to network that way. That's one way to do it. Good old-fashioned networking events, I think, is an important part of any early-stage entrepreneur's time. You got to shake the bushes and get out there, see what else is happening, get a perspective of what you're up against, meaning what other companies are raising money at the same time that you are. And then typically entrepreneurs band together. They're, I think, part of the great culture of Silicon Valley and, and all over the world is people taking the time to help each other. And it might be a good idea for you to help other people without asking for anything in return to start building up some kind of debt in the ecosystem for them to owe you. So if you are helping people and helping them with their design or whatever skills you have and contacts that you have, then it tends to start to pay back to you. And that's a good way to get introduced to investors.
I think those are several great points, Andrew. You mentioned a couple different kinds of investors. Would you give a brief overview of what the difference is between an angel or a super angel or a venture capitalist, and at what stage they're appropriate for the investment life cycle?
Sure. I mean, I remember as an entrepreneur myself and then advising, I made angel investments and then would help my companies raise venture capital funding. And one thing I found frustrating was, you go out and meet with a bunch of investors and they say, come back when you've got more customers and more revenue. You're too early for us. And then you come back to some of them and they go, oh, we don't invest at valuations this big. You're already too far along. We like to invest when we're still helping populate the management team and getting those first customers. And you kind of feel like you're in a catch-22. So the logical response to this is to try and gain an understanding of the active investors in your sector and geography, and when do they play? Are they truly investing across stage, like an NEA, or are they only investing, at a later stage or only investing at an early stage? So the key kind of players you've got, friends and family and people that know you. I even think it's worth whipping out a piece of paper and say, where was I born? Where did I go spend my summers? What schools did I go to? Who did I know that was rich? What were their parents like? And then kind of try to rip out of your past memory everyone that you've met in your life, and then reach out to them and say, hey, maybe some guy sold a bunch of radio stations or something. It's got nothing to do with your industry, and just say, I'm starting up a business and I'd like to talk to you about it and just get your advice. It depends how desperate you are. If you have a lot of real angels, that might be considered a waste of time. But if you're just asking for advice, they might give you some good advice, and subtly, you're saying, would you like to consider making an investment in my company? People that already know you, your old boss, guys that used to work with you, sometimes guys that were working under you that have gone on to make more money, these are a good starting point of people to raise money from. So I think that the first investors should come from people that you already know. I had a drink with an entrepreneur from Harvard where I was speaking last week, and he seemed unwilling to raise money from his own family, and he had even said no to offers from his family to take their money. And he didn't want to cloud his clear family-only relationship with a business relationship. To me, that's a mistake. I think if you're a hardcore entrepreneur, you're just going to move as quickly as you can and make sure you've got good investors on your side. So I think friends and family first. Identify angel investors. Go to lots of networking events. Getting into an accelerator, if it's a good one, can be a good path to meeting a lot of angel investors along the way during the program, and then leading up to the demo day, and then on Angel's List by leveraging the internet and being having high optics as a graduate from a reputable accelerator. That is becoming a bigger and bigger path to doing that.
Andrew, I don't mean to keep cutting you off and asking you to define terms, and I apologize for that, but I keep hearing the term accelerator and incubator and co-location facility thrown around in the ecosystem. What exactly do you mean by those different terms, and how do they differ from each other?
Okay, so I hear people use different terms incorrectly, and then I hear some use different terms for themselves trying to increase their kind of value proposition too. I view it like this. An accelerator is a program that typically is 3 months or maybe a little bit more, and their business model is that they take lots of applications like Harvard University. They only accept a subset, so there's a bit of filtering, and then they take typically something like 7% of the equity in that company, and usually they're making a small investment, like something like $50,000 per company, and the company survives on that money during the 3-month program. And historically, you kind of spent the first month surrounded by mentors, getting your strategy down, making sure you're not hallucinating but you've got a good vision, and then kind of what market are we disrupting. Then they spend the second month kind of heads down making their product. And there's a lot of kind of lean startup review every day. What did you achieve yesterday? So they're motivated to kind of not sleep and work very hard. And then the third month historically they were kind of getting a crash MBA 101 course on how to raise money. That's changing. I was at the Y Combinator demo day, 2 weeks ago, and these companies seem to be much more advanced, and they're focusing on sales execution from day one. But for the accelerator, at the end of the 3-month program, they want to kick everybody out and get a new batch in and get their 7% of a whole new group. So the accelerator is motivated to get good companies in, take 7% of the company, add a lot of value, and get rid of them and get a new batch in to basically have highly diversified investment thesis going for the accelerator operator. For the company, you get accelerated during 3 months. You get a very good education. You get help on your product and your user design and a whole wonderful education and a lot of network and contacts, which is obviously, in my opinion, very important. So it's a good value proposition for most people. So usually the $50,000 at that valuation is neither here nor there. They were basically giving up a lot of equity at an incredibly low valuation for other value they were getting. Now, an incubator, I think of in the same category as a shared workspace. Here, the owner of that incubator is motivated to keep you there as long as possible, and they're charging you per seat, per desk, per office. It's a real estate play, and it's an office. And so people pay money to rent office space there. Our office is in a WeWork facility in the Meatpacking District in New York City. And then I share an office with VCs in Silicon Valley. And, both places are a bit of a beehive with activity. So in the incubator, rather than just be alone in an office, you're renting office space or a desk surrounded by maybe 300 startups. So there's angels walking through, there's VCs walking through, Mark Zuckerberg might be walking through there. So people have value in paying a higher rental rate to be there than somewhere else, and also it can be flexible. It can be month to month. Whereas renting an apartment or anything in New York City can be difficult, and they want deposits and all that jazz. So those are two key differences. One is getting your equity, adding value, and kicking you out. The other one's office space. But the incubators or shared workspaces are trying to justify even higher office rates and sometimes even trying to get equity. And so they start saying that they're offering accelerator-type programs a la carte or something like that, or they're having a keg with let's all get together and commiserate about what we're working on. So that it starts to blur a little bit. But I think if they're trying to keep you there and they're charging you money, it's an incubator or shared workspace. If it's an accelerator, they're trying to kick you out after they're done and get equity in some other company.
I think that clarifies quite a bit for me. I have some questions I wanted to ask you about how you determine valuation. But before we jump into that, Andrew, are there a few questions from the audience that you want to answer?
Yeah, there's a lot of questions here. Let me try and read some of them.
And once again, everyone, while Andrew's taking a look at that, please submit any questions you have on the chat box in the lower left corner of the screen. Andrew is an expert in a lot of different areas of the early stage ecosystem, and he can probably talk off the cuff about any of the questions that I could throw his way, but we want to make sure that you all get the value you want out of your time.
Yeah, Julie Meltzer asked the question, can an entrepreneur contact a law firm if they have no relationship with them? If so, what's the best thing to say when calling for a meeting? I think the best thing to do is to get the very best executive summary, a 1 or 2 page executive summary, in a 10-page slide deck in PowerPoint or some other kind of design system, and then email it to them. And if they don't respond, follow up with a phone call. And as far as law firms, there's a few law firms that contributed to my book, and those individuals that are the ones telling stories in my book are all good ones to contact. My book, by the way, I brought together stories from 40 different VCs, lawyers and CEOs, where they tell a story where they learned something and trying to make it entertaining as well. And the lawyers that are listed there are all good ones. If you ask around who's the best corporate securities lawyer representing startups. You can kind of figure that out by going to networking events. I think if you actually cold email them, you probably get through. But there's nothing like it.
Can I say, Andrew, that before Andrew's first chapter in his book, he's got 2 or 3 pages of the different people that contributed to his book, and it really is. He has the who's who of the powerhouse lawyers throughout the United States in the early stage technology ecosystem. So, if you're looking for great lawyers, if for no other reason, buy Andrew's book for that purpose.
You actually don't even have to buy it. If you go to Amazon, they let you click on this. If you see the image on Amazon.com and you click on this image and it says look inside, you can see the whole table of contents. And I think you can get all that information without buying the book. So you just type in Andrew Roman on Amazon.com and it should come up. And click on look inside and you can see a list of guys there. And then you can say, I found your name reading Andrew Roman's book. And they should be responsive. So a bit about pre-money, post-money valuations. I think, we're short on time, but I think this is an important thing that anyone who's selling equity in their startup should have an understanding of. One is usually the early money these days is being raised on convertible notes, and I explain this in the book. But in brief, if you're getting 10 or more or even 5 different investors to invest in the company, it's difficult to understand, well, what is it worth? If I invest $25,000 or $250,000, how much percentage ownership of the company will I get for my investment? And if the company has got 3 people working on it and no revenue, it's kind of hard to even agree on valuation. So what often happens is the money comes in as debt, and that debt will convert to equity at either a discount to the next valuation that comes later, or so that would be a priced round, or it has a cap. So so often these things look like the convertible note has a cap of $3 million, a discount rate of 20 or 30%, and an interest rate. And so if the company ends up raising money at a valuation higher than $3 million, then these angel investors that came in early, that debt will convert on a dollar-for-dollar basis at a pre-money valuation of what it was specified in the cap, $3 million. If the company raises money and sells equity in a priced round, so it's not a convertible note, at a valuation that's lower than the specified cap, then the discount rate comes into effect. And if it were a 30% discount rate, then they would be converting their debt to equity, buying shares, at a 30% discount rate to the pre-money valuation specified in the priced round. David, should I try to quickly explain pre-money and post-money valuations?
Yeah, I think just a real brief overview, and maybe there's a lot of questions about what should be expectations in terms of valuations at different stage, and how should entrepreneurs think about that, and how should they prepare themselves for that valuation discussion?
Yeah, which I think is a much more interesting topic and more appropriate for this call. I think that one thing I've noticed is that humans come out of the womb as babies screaming and understanding about dilution. So every entrepreneur seems to be born very concerned about starting off. They start off owning 100% of the company. Maybe they get a co-founder, so it's 50-50. And every time an investor comes along, they're extremely worried about valuation. And they're extremely worried about dilution, these two things. And I think that in general, I'm sure if you talk to some guy like Jack Dorsey, who is going from Blogger to Twitter to Square and Medium and all that, I'll bet you that guy is not obsessed at all with valuation. And he's not obsessed with dilution. He's probably obsessed with quickly getting the right people into the deal. So I think in general, valuation is extremely important, and you should be networked to advisors, and that could be lawyers or people like David or people like me that understand where a company like yours should be priced. Just like if you want to sell your house or apartment, there's a certain pricing of where it's expected to be sold. And a real estate agent should be able to advise you on pricing it for selling, not too high or too low. And so there's something similar in the startup world. It's somewhat geographically based as well. So you should get advice on what the right valuation is, and not sell at too low a valuation. But I wouldn't be so concerned with dilution. I'd be more concerned with getting good people into the company that can make the company survive, succeed, and increase the valuation. Another important thing to say is that sometimes an entrepreneur can raise money at a very high valuation for a pre-revenue startup. And they will. What worries me is that they'll burn through some of that money at a time when it was all sort of a bright, shiny object without any revenue. And then when the revenue kicks in, it might come in very slowly or even not come in at all. And that startup may burn through the money they raised and need to raise more angel funding or venture capital funding. And it may be that they have to raise money. They can only get money in the door at a lower valuation. And so a lot of the people that invested in the first round, let's say a $10 million valuation, may be very concerned about investing at a 7 or 6 or a $5 million valuation. They may be unwilling to invest again at a flat 10. And it could be the death of the company. So I think that it's important for entrepreneurs to plan for the next round when they're raising the current round and think, well, if we raise money now at a $3 million, even if things are not going well, we will have done work. And we can say that we're raising more money at a $5 million valuation. A lot of the people, even some of the novice friends and family, may say, you know, honey, saying to their spouse, we bought this at $5 a share, and it's already up at $7.50 a share. We're making money, and they'll continue to invest more money in the company. If it were a down round, it might be the opposite. They say, oh, no, I invested at a $10 a share, and now it's already down to $5. I've lost half my money. But of course, that's completely not really accurate, but it's a very real perception. So I think it's important to go from stage to stage to stage where it's going up and to the right.
I think that's a great point, and I think it gives a great overview of how you should think about valuations. If you are an entrepreneur and you're just starting out, and I know a lot of our audience members are in this situation, what is the best thing that you can do, Andrew, to really make sure that you're building a company that's going to maximize valuation? What are the 1 or 2 things that the folks on this call should be thinking about in terms of creating that value?
Yeah. Well, I think that the building blocks of valuation that I think of are, management team, product/service, and maybe even distribution channels they have, and revenue. So discounted cash flow is a, tried and true model of valuing a business, and then comps, comparables, is another kind of classic way of valuing companies when you're doing an IPO or a merger or some kind of offering. In the early stage technology world, a lot of these companies, their revenue is either hasn't started yet, or it's kind of only validation revenue, or that they're generating some revenue, but what they're really working on is getting this data that they're going to monetize in a different way, so that the revenue is not even indicative of the pivot that they're planning. So if the revenue is not really driving the valuation of the business, then the spotlight moves to those first 2 building blocks, the management team and the product/service. And, if you're not Steve Jobs, or that you don't have a past track record of making things happen in the entrepreneurial world, the management team might be challenged. And so ways to try and build that up are recruiting people into the team that have a real track record and story, or advisors, investors, and board members to kind of surround around that. So that's something that you can do, is address your human capital story within your business. Sometimes, and I think I mentioned this in the book, I did it myself. When I was an entrepreneur, in the 90s, I recruited 5 people to join my company as pretty senior kind of lieutenants in the business, each running a major division, contingent upon $5 million of funding. And it's hard to raise that kind of money now for an early stage company, but I signed employment contracts with these people saying contingent upon $5 million in funding. Here's your salary, here's your stock options, here's your mission, your job title, and what you're going to be evaluated on for your bonus. And I was able to walk into investors with a business plan and a management team fully populated to execute that strategy. As far as building value these days for early stage startups, I think that for digital startups, I talk about a couple models in the book. One that I like is that when Skype was launched, Nicholas and Giannis, they had founded a copycat of Napster, Kazaa, and they had 11 million users going there to steal their music and other stuff. And basically were comfortable with peer-to-peer, fast broadband connections, all you can eat. It was the perfect set to target for downloading Skype and using that. And so it was the button on Kazaa that was the secret to Skype being so successful. Now, they had a good voice codec and global IP sound, but and good user interface and all that. But I think that companies should search for some kind of button on Kazaa, some kind of viral thing that will help grow the company. MySpace had music, and the music bands had these huge fan bases. But at any rate, on growing value, David, I don't want to just blabber on too many things. Trying to keep it to specifics. It's really, the revenue, the product, and the team, and try and think how you can move the levers to make the arrow go up, on those key things. One thing that's very clear to me. Go ahead.
I think, Andrew, your point about team when you have a very early stage startup is incredibly key. Because at that point, it's just idea and concept. So I think what you're saying about team is very, very relevant and is probably the most important thing for an early stage company. I want to be a little careful about time. We've got about 8 or 9 minutes left, Andrew, and I want to give you a little bit of time to say some closing comments. Did you want to jump in and see if there's some questions that you wanted to answer from the audience? And once again, everyone, you can submit questions on the chat box on the lower left corner of the screen. But Andrew, did you want to pick a couple questions off of there, and then you could have just 1 or 2 minutes to say some closing comments? I think you've had a lot of incredibly valuable advice for us on this call today.
Yeah, I'm looking through some of these questions. What is the average time a venture capitalist will say yes or give a heads up? The bigger question is, what's the average time between meeting the venture capitalist and getting a wire transfer into your bank account? Because you guys.
That's a very relevant question, Andrew. That's a good question to answer.
So a good CEO always keeps their eye on the cash. When I meet a CEO who is unaware of cash, I get very concerned. I think a short answer is for the mortal, normal people, expect 4 months if things are going well. That may sound like a long time. David can weigh in on this too, but even after
3 to 6 months, it takes a long time.
Yeah, and expect too that you're going to have your own built-in delays. Well, we really want to wait until we've launched this deal with the Home Depot or something, and then that'll turn your 4 months into 9 months. I've even jokingly said it's like having a baby; it hurts like hell and it takes 9 months. But I think closing comment before we run out of time is that there seem to be more startups starting up than ever before, and there's many reasons for that, from culture to accelerators to it's hard to get a good job, or the job security of the big company is less than the startup these days. But there certainly seem to be more startups seeking funding than ever before, and at the same time, the total capital in the asset class contracted, and then it somehow expanded again in the later stage. And we've got this new breed of micro VCs out there, so there's sort of a new birth of more VCs looking to invest into early stage companies like my own. But I think that the logical conclusion from this is that it's musical chairs. When the music stops, there's not going to be a chair for everybody. There's not going to be funding for everybody. And so I think that there will be guys like Jack Dorsey that can come up with a new business that will not seek to monetize or generate revenue for quite a while. And his business model to survive will be on investors. So investors will invest in the company, and they'll make their payroll and pay for making their product and stuff. But for the large mass of companies, there's not enough VCs to fit that. So I think that if I were an early-stage entrepreneur, I might consider coming up with a business idea that can generate revenue quickly. I think if you can come up with a business that generates revenue quickly, investors will find you. All my startups that I founded generated revenue and didn't need investors until one that was generating so much revenue that the VCs wanted to invest in it. And we liked the valuation, and we took VCs in, and then we grew really fast. So, one thing is customer financing. Sometimes you could, if it's an idea that really requires a product before it can make revenue, find a customer that wants that product and say, if you pay me $40,000 a month for 6 months, then I can have the product working for you in 6 months. And then I'll own the intellectual property, you'll get what you wanted, and we will service you, and then you can pay a service agreement. So kind of, parting words are, it's possible to create a company and get funding along the way, but it's also not a bad idea to come up with something that makes money. Somebody might be laughing because it sounds so stupid, but companies that make money make sense to me.
That's a cool way.
I got one other closing comment. It's a little self-serving, maybe. Is that a good bit of advice is don't become an entrepreneur. Stay with banking, consulting, or big corporate life. Get a job at eBay and just grow there and be wealthy, and make angel investments. So another thing you can do is don't sign up for suicide and be an entrepreneur, because most will die. Stay where you are and go to demo days and invest into a group of different startups, and consider spreading your bets across a group of different startups. It's another parting advice that many people won't give it to you.
I think that's, this is all incredibly valuable, Andrew, and, I think that your book is an excellent resource, and I've loved it, and I know that you're also doing very exciting things with the Georgetown Angels and making a lot of wonderful investments, and you are really a leader in this ecosystem. And so I really appreciate the time spending an hour with you. Vishal, did you have any closing comments? Thank you for hosting us.
Yeah, absolutely. Thank you so much, David. Thank you so much, Andrew, for being here. Definitely learned a lot, and I'm sure that our audience as well. So final comments and announcements. This presentation will be available on demand on business2community.com website. And before we close, I would just wanted to make sure that our presenters here just say a few words. If anyone would like to follow up with Andrew or David, what would be the best way to follow up with both of you? I know that Andrew mentioned his book is an excellent resource that everybody should get. But David, if anybody would like to reach out to you as a mentor with some questions, what would be the best way to contact you?
No, thank you. Thank you for that opportunity. So our website is earlygrowthfinancialservices.com. And on our website, we have a large list of resources. We've got over 25 webinars. We blog a couple times a week, and we have a lot of materials for entrepreneurs in the early stage ecosystem. And all of my contact information is on our website. So please reach out to you. We're in 9 cities across the country, but we have companies and clients nationwide. And we're always excited and eager to talk to early-stage entrepreneurs at any stage of development.
Great. Thank you, David. And Andrew, beyond your book, what would be the best way to reach out to you?
Yeah, so we're rebranding as Rubicon Venture Capital, so our new website will be rubicon.vc. But for right now, the best is to go to georgetown-angels.com. So Georgetown-Angels.com. And with our fund, when we invest in a company, we don't take board seats like the classic VC. We think that the VCs get on too many boards and can almost become destructive. And so our investors are angel investors and mostly successful entrepreneurs. And they invest small amounts, as little as $50,000 into our fund. And then when we make investments, we try to populate each startup with a group of advisors and or board members. And then when the fund is making multi-million-dollar investments in the companies, again, it's usually these guys that join the board, which we think is a much more positive way to go. For those of you that are in San Francisco, and I mentioned networking events are a good thing, a lot of our angels, like many of our venture partners and angels are coming next Wednesday, April 16th at the W Hotel in San Francisco. I'm organizing a book tour event, and you can find details if you go to my Twitter account, which is at romansventures.com. If you can see the screen, it's there. ROMANS Ventures is the Twitter handle, and there's a link to register for that event at the W Hotel. We've got something like 9 VCs on 2 different panels, and we've got a Bitcoin panel, and then I give a little book tour talk, and hopefully we can meet in person.
Great. Thank you so much, Andrew. Thank you so much, David. Thanks, everyone who joined us today. And we'll see you.